Hello, everybody. Peter Murphy and Chase Clark here with the Buying Tampa Bay podcast. Everywhere you go, you hear dire warnings these days of the imminent crash of the housing market. A recent data point on inventory or prices is thrown out as proof positive that we're in for a meteoric collapse in the housing market of some magnitude that's similar to the crash that preceded the Great Recession in 2008 and 2009. And people love to remind me of this fact too. I've got financial advisors and friends and ex-friends and acquaintances all telling me that this crash is just around the corner and that I should hold on to my socks because of what's coming. But today, with the same fervor as the naysayers and hopefully a little more evidence, we're going to tell you that the housing market isn't going to crash in Tampa Bay anytime soon. What do you think, Chase? A little overconfident of us?
Yeah, I don't know, man. It's hard to know what the crystal ball is going to show over the next few months or even few years. But if you live here in this area and you've got your pulse on the housing market, it's hard to be negative. I mean, especially this time of year. I mean, these are our Chamber of Commerce weather days right here in January, right? Drove across the bridge last night, beautiful open water, crystal clear blue skies, beaches. You know, what more could you ask for, right? And that's what's driving demand and all these people flooding into the area. It's so hard to have a downturn or a bubble bust when there's so many people coming to Tampa Bay.
Yeah, demand's a big deal, right? I mean, it's one of the things in our research over the last little while that has driven a ton of confidence on the part of most locals here in the Florida area about the Florida market in general, but of course, Tampa in specific. It's hard to forecast a doom and gloom scenario when you have thousands of new homeowners moving into the area every month, which is what we have here in the Tampa area. So I think it should be said right out of the gate, between great weather and amazing economics and migration into Florida, we're talking about some local dynamics here, right? What we're saying does not necessarily apply to every state in the union. We're talking about a Florida reality. The Florida housing market, and more specifically the Tampa housing market, isn't going to crash anytime soon, in our opinion, because of some stuff. But other markets in the nation may not be in for such a rosy outlook.
Yeah, you know, and I think there's a big difference between consumer sentiment and the facts of reality of what's actually going on in any market. Because if you turn on the local news every night and you're listening to rising interest rates, crashing stock market, recession on the horizon, all the bad things going on, that's going to play on your psyche, right? And so it's real easy to fall into this trap with the media of thinking that doom and gloom is on the horizon, that we're in a bubble, it's going to burst, and it's going to be just like 2008 again. But there's so many reasons, and I think several that we're going to talk about today, that we just don't think that's going to happen.
So a couple statistics that I think are really important just to throw out to, for us to understand in general about Tampa Bay. I'm going to read these off my list. I wish I had them at the top of my tongue, but in the Tampa Bay area, we have 3 million people. That's just in the Tri-County area of Hillsborough and Pasco and Pinellas County, about 3 million people. And of that 3 million people, that represents about 1.3 million households or homes in our area. So it's a huge market. It's not the biggest market in the nation, but with those 3 markets only, we've got plenty of households, plenty of people in the area. Now, the growth rate in this region is, just for Hillsborough County, is expected to be 12,000 households per year for the next 5 years. So between now and 2016, we project in Hillsborough County that we'll see a growth rate of about 12,000 households per year. So it's very important to remember that kind of growth rate brings with it some intrinsic improved economics, some massive new buying power, an increased tax basis for the marketplace, and all kinds of demand, as you could imagine, for our local housing. We're not in a market where people don't want to live. We've got lots and lots of people. Our size is our salvation, and we continue to be desirable for people moving into the area. Some important facts to remember right out of the gate.
Yeah, and so when you look at that kind of demand, with the number of people that are actually moving here, I mean, these are not myths. This is not just something that you're hearing about. It's actually happening. You know, where do we get supply? Where do these people live, right? For a while, we saw a huge housing boom here. We saw builders building to beat the band. We saw apartments going up everywhere. During COVID, that kind of slowed down, and it slowed down for long enough that I think we're having a hard time catching back up, right? And so that kind of leads us into, well, where does housing value go a little bit? based on supply and demand, right? We've got so many people coming in. We've got a shrinkage of supply compared to where it should be on a normal run rate. And so prices have got to hold fast or rise. That's just the reality of economics 101.
Well, and add that to that reality, the fact that in our existing inventory on the market right now, we don't have numbers of available listings to feed the influx of new residences. So there's about 600 homes in this Tri-County area that are on the market as of right now that represent the median kind of home. And the median home that's selling right now in Hillsborough County is a home that's about 3 beds, 2 baths, that's 1,800 square feet, and that's selling for less than $400,000. And so a home that meets that statistic, there are only 600 of those homes on the market right now. So if we have and that's in all that Tri-County area. So if in Hillsborough County alone, we have a growing population of 1,000 homes a month, and then add that Pasco and Pinellas, and so we're probably looking at close to double that. There's nowhere close to existing inventory to feed the demand for that increased that projected increased supply in buyers. Meaning builders have to beat demand to beat demand in order to meet that demand. Boy, that was a tongue twister, but you get the point. In order to have enough homes to house all these people moving in, we must have a surge in building, in addition to a good stock of housing added to the market. And that is what we're seeing right now, but possibly nowhere close to what we need to see in order to meet the demand.
Yeah, there's several headwinds there because builders want to build, I believe, especially in this area where there is this pent-up demand. But because we've grown so fast over the past 10 years in this area, county governments have had a hard time keeping up with infrastructure. And so they haven't been willing to release the kind of building permit volume that these builders desire and that they need to meet this demand. And that just kind of adds fuel to that fire of lack of supply, continued strong demand for the product. And so, people are willing to bid up the price to get what they want.
Well, we did some research, and we have 3 major points that we think indicate that the housing market is not going to crash in Tampa Bay anytime soon. And so let's go through those real quick for our audience today and just kind of share what our findings are in that and increase maybe their confidence based upon some of these facts that we're encountering. Number 1, the foreclosure docket. Now, the foreclosure docket is a current snapshot of foreclosure activity. But anyone who is in the market during the Great Recession remembers a packed foreclosure docket. I mean, you would open up Real Foreclose and you would see what was being sold that day on the foreclosure courts, and 50 or 60 properties every single day in every single county were going to auction. And boy, were these being snapped up fast and for low prices, right? We had a huge number of homes every day selling, and that was because we had all kinds of default. We had people who were selling these homes without equity. They couldn't hold on to them. And we saw just a huge volume of foreclosure cases in the foreclosure courts. How are we today compared to that reality?
Well, we're nowhere near that, right? Boy, I just had some fond memories of 2009, 2010, pulling that thing up every single day and looking at that calendar. I mean, it was just like opportunity abounded while some were suffering, and I think, that was a sad time for so many people, but a time of so much opportunity. And one interesting thing that I think is so different today than back then, aside from just the sheer volume of foreclosures that were available to buy at auction, whereas today we've got 2 or 3% of that volume going on a daily basis, is that banks now are more willing to take these properties back. So even when these properties hit the foreclosure docket, I haven't looked at the actual statistics, but several days that I have looked at where the banks are taking it back 50% or more of the properties and not allowing them to sell because they feel like the property's worth more than the investors are willing to bid for it. Well, back in 2009 and 10, you didn't see banks taking back any properties. I mean, maybe 1 or 2 a month. It's because they had to clear their balance sheets. They were in bad shape. They had regulators coming in and they had to get cash in the door to satisfy the reserve requirements that they had, which they couldn't meet back then during the banking crisis. So you've got another competitor in the field, and that's banks. So properties aren't selling nearly at the volume they are, even if they do hit the docket today. But volumes are just way down, right? Way down for many reasons, but people are not having problems affording their homes right now is really the message.
Well, that's exactly right. They have huge amounts of equity in their homes, and so they don't want them to sell at foreclosure, because if they do, then whoever buys that home up, well, they're getting a really great deal in all likelihood, and the buyer is walking away from some serious equity that they have in the property, and they're not wanting to do that. So we went back and took a snapshot of what some sales were over the last few days, and it's not uncommon at all for us to see a foreclosure day where 0 homes have actually sold at auction. But maybe we see a day where 1 or 2 or 3 or 4 sell. And what's a very interesting dynamic that you'll see when you look at these foreclosure dockets is that 4 might sell, but 8 were supposed to sell. And on the last minute, 4 of those buyers or those owners of those homes who were supposed to lose their home in foreclosure that day negotiate some kind of a release from the lender. They either get a stay of foreclosure, or they file a bankruptcy so they have time to renegotiate their mortgage, or they negotiate a modification to their mortgage so that the lender drops the mortgage suit, the foreclosure suit. And so a whole lot of activity like that is going on so that borrowers who are nearing and facing imminent foreclosure are not actually going through with the foreclosures at all. It's not in anyone's best interest, and certainly not theirs, for that home to be taken off their plate. And so literally we're seeing almost no foreclosures happen in a given day. But where we do see foreclosures, what are we seeing in terms of the value of homes? Are we seeing these homes sell at like steals of deals, or people are picking up fantastic product at great prices? Or are we seeing something else?
Yeah, it doesn't appear so. I mean, day by day, when we look at what's available out there, you don't know what a home's going to sell for on any given day. But then when you look at what the auctions actually closed at, there are investors out there that are putting a lot of money at risk to buy properties very close to market value at the auction that still need a lot of work, and also still may be occupied by the borrower and have other costs with attorneys and eviction fees and things like that to go along with it. So buying at a foreclosure auction, number one, is a risky thing to do. So you would always expect to have some kind of significant discount to market value, but we're just not seeing that these days. I mean, we've got several examples of a home selling for 85 to 90% of market value at the auction, and then requiring significant repair. And that just wasn't happening, 15 years ago.
So more than anything, it appears that people are using the auction as an opportunity or a place where they can actually buy a house relatively quickly. Because if you look at the public exchanges, well, there's not a whole lot for sale on the public exchanges right now. And you can't certainly buy things very fast there. There's a window of time that's required, usually in excess of 20 days, in order for you to close on a home that comes on the public market. Plus, if it's any good, you've got negotiation happening on it, which is driving that price up. And so what it appears to be is that investors are using the foreclosure auctions as a place to go to get a house today that they might need, to spend money right now, or to target a home that's closing in their community, which they really want to get their hands on. They're familiar with it for some reason. They've been watching it, and now it's going to the foreclosure courts, and they're buying that. Not a tremendous discount at all, but they're just getting their hands on a house. And for many investors, that's an important thing to do as they try to spend the money they have allocated for that strategy. So interesting to see that dynamic. So really what we're saying in all of this, Chase, unless I'm mistaken here, is that we need to see a surge in foreclosure filing along with a major loss in home equity for the foreclosure markets to present a significant challenge to us once again, for us to look at this and say, hey, this is imminent, that we're dealing with a major housing crash sometime soon. And what we're seeing is just nowhere close to that. We're not seeing the volume of homes on the foreclosure docket. We're not seeing homes selling that seem to be bereft of equity. And we're seeing people pay market value for homes. The foreclosure dockets do not present a current reality of a housing market crash.
Yeah, and we've heard the term bubble so often over the past 2 years, and how we've got this COVID housing bubble, right? And they define the bubble as a rapid rise in asset prices. And we have, over the last 2 years, seen rapid rises in home prices throughout Tampa Bay. But so many people are looking to the foreclosure docket as the litmus test of the bubble bursting, right? They're looking for that event to happen where foreclosures balloon and therefore the bubble bursts, and we have a huge correction to the market. And, I think we're definitely saying we don't see that yet. And we probably don't see that coming in the future either, because of all these dynamics we've discussed.
Right. And even if we're concerned a little bit about default, which we are, we suspect that if there is a widespread recession and accompanied job loss, you might see an uptick in default. And default takes about a year for it to hit our foreclosure dockets. We're saying that even if that reality, that dynamic is a reality, it's a year plus out. And that gives significant time for various market factors to kick in, which would alleviate this concern. For example, we might not see a continued drawn out high interest rates on mortgages. And so if we see mortgage interest rates fall in 2023 and demand tick up for homes naturally, then people who might be facing default due to foreclosure have an option to list their home for sale on the market, and for there to be ordinary market buyers that would come to the rescue in those scenarios and take those homes off their hands. So a lot can happen in a year that would dramatically improve the prospects of foreclosure for people who might be affected by a recession today.
Yeah, that's true. And so will we see flight from the area when that happens? That'll be the question, right? Will people leave the Tampa Bay market and head to a tertiary market like Central Florida or somewhere like that, where they might see a 10 to 15% reduction in their cost of housing? That'll be the question. And so much of this is predicated on, are we going to have an economic downturn in this country? How hard is it going to hit unemployment? And are we going to have a wage and affordability issue when it comes to housing for people in Tampa Bay? And so much of that is up in the air. But when we look at those dynamics in the economy right now, it's so resilient. I mean, unemployment is still at some of the lowest levels we've seen. Interest rates are falling. Affordability is kind of hovering, right where it should be. And so all that's kind of looking up as far as, are we going to have catastrophic default? The economy is doing us a lot of favors right now, saying probably not.
Well, reason number two that we suggest there might not be a crash in the housing market anytime soon, there probably won't be a crash, is this concept of inventory levels and climbing prices, right? So we keep hearing that we're in a really big bind right now because inventory levels are so incredibly low and because so few homes sold last month. Really, that's the common byword, is that 40% decrease in home sales this last month. And everyone there's like, oh my, we're in for a housing market crash. But what we thought we would do is take a look at a representative zip code in Tampa Bay, one that kind of has a nice mix of homes and that might represent what's going on generally in the market. So we went and looked at the new Tampa zip code of 33647, and that includes Tampa Palms and West Meadows, Cross Creek, much of New Tampa, Live Oak, things off of that extension of Bruce B. Downs, if you're familiar with our area, into all the suburban homes that are in that area. Lots and lots of housing. So what we discovered was that as of today, there were 102 active homes for sale in that area. And in the first quarter of last year, 184 homes sold. So compared to last year, 43% fewer homes for sale. That's a big number. That's the kind of number that everyone's talking about that represents a housing market crash. But here's the reality. Econ 101 teaches us that a shortage in supply leads to increased pricing, not a crash. So, Chase, is that what we've actually seen? Have we seen pricing go up in response to this drop in inventory, or, nail biting, is it going down?
Yeah, well, percentages are dangerous, right? 43% sounds like a big number, but in reality, when you look at the actual numbers, 102 homes for sale, 184 homes sold in the prior year, you're talking about a geographic area in this zip code where 200,000 people live. There's a lot of homes in this area, and to only have 102 active homes on the market right now, far below what this area is going to need to sustain normal churn of move-ins and move-outs, not to mention the new people that want to move to this area. So you're exactly right. I mean, shortage of supply, is going to lead to increased prices. So, the median price right now being $213 a square foot, up 4% year over year from 204 a square. So we've seen this, it's not the 15, 20% increases we saw during COVID year over year, but 4% is a very healthy rise in price for any geographic area, in 1 year's time. So are we trending in the right direction? I definitely say so. And a lot of this is because of supply and demand.
Well, 4% is an interesting number, right? Because realtors and the Housing National Association of Realtors has long put out 4% as a normal real estate growth appreciation rate. And so if what we're saying is that right now, in the midst of a market where interest rates have been, at least for the last few months, on the rise, and we're getting the constant drumbeat of an impending recession, and people are preaching housing market correction like it's the end of the age, we're still dealing with a normalized appreciation rate of homes. And that's a remarkable thing. You would think at the very least we would be in a market where home prices are even. And if we went out there and polled the general populace, my sense is that people would tell us that home prices are rapidly falling, which is not the case at all. We're looking at this market and we're seeing an increase in home prices over this time last year. Now, we are seeing a small flattening from peak pricing. And so peak pricing hit roughly the summer of 2022. And here we are in January of 2023, and we've seen a slight softening from peak pricing somewhere around the 1% mark. But man, that is not a housing market crash. That's not the precursor of a housing market crash. A 4% increase in home prices year over year is nothing close to a housing market crash. What we're seeing is that we have a shortage of inventory. People can't buy homes. People are reluctant to put their homes on the market because, well, they don't know what we're going to be dealing with from buyer demand if interest rates remain high. And so they're holding their homes off the market. And that's why we're seeing such a decrease in inventory, why we're seeing so few homes sell, because simply put, there isn't enough to buy. But what is selling at higher prices. Unless I'm totally misreading this, higher prices does not make a home crash.
No, it makes a market softening. That's what it does, right? It says, so some people look at it like this, right? So we saw the year-over-year inflation rate hit almost 7%, right? For the CPI South. So if you've got inflation last year, like I think it was 6.8, 6.9%, and home prices only go up 4%, you're like, oh no, home prices are not keeping up with inflation. But it's so dangerous to lock into very short periods of time when you're looking at trends in any market, right? And that's no different for housing. I mean, if we go back to 2019 and you look at the beginning of 2019 to the end of 2022, we've got an awesome run up in housing prices during the end of 2021 and the first part of 22. But 2019 started out very stable. And the end of 2022 and so far beginning of 2023, again, very stable. So that's what markets do, right? They go up, they go down, they become fiercely steep, and then they kind of table off a little bit. And so we are seeing a softening, right? We can't go out and demand top of market price and have bids coming in over ask like we could back in the summer. But does that mean that home prices are dramatically falling, and are they falling below where we expected them to be before this giant run up? I think most people would say no. Does it feel good if you're trying to sell your home now and wish you would have sold it last summer? No, it doesn't. And so that does play into the psyche of every seller thinking, well, okay, I missed the market. I missed the peak, right? But so many people miss the peak. It's the anomaly for people to hit the peak. And I think that's an important thing for people to learn and not get discouraged by when they're looking at a market that maybe feels a little bit less exciting than it was 6 months ago.
So we're in a home market here in Tampa Bay that has received roughly the receiving end of 10 years of home price appreciation, steady home price appreciation, and 3 years of extremely strong and outsized home price appreciation. So what we're really going to have to see in order for us to attribute a market correction or a substantial market correction to Tampa Bay is we're going to have to see a drop in home prices year over year, a big one, enough with price trajectory. So that means downward falling of prices, substantial enough to erase many years of appreciation, depending on when the average person has bought their home. And right now, the average duration of homeownership is in excess of 7 years. So you're imagining for yourself, for most folks to be in a really tough bind, they must see downward trajectory of home prices for a long enough period to erase all of their gains. And that is many percentage points of price decline. Let that happen for a long enough period of time, and you might have a scenario where a market correction and a more substantial one could ensue. But a 1% drop from peak, a 4% rise, that is absolutely not where we are. It's reason number two where I just don't think we're going to see a correction in the housing market or a crash in the housing market anytime soon here in Tampa Bay.
Yeah, and so you may ask yourself, so if you're a homeowner, why are you concerned, right? Why are you concerned that prices are no longer going up 10, 12, 15, 20% every year, right? And you may be looking at your home equity thinking, during COVID, I took out that $50,000 HELOC so I could put in a pool or put in an outdoor kitchen or remodel my home, my bathrooms, whatever. And so I took on that additional debt to my home, and now my equity is not rising like it was. I took that out kind of on the forecast that things would keep going, and I really wasn't doing any damage to myself from a net asset position by taking out this HELOC. Well, you're still in a good spot. Don't panic, right? Homes haven't dropped 30% in 1 month like they did back in 2008, right? We don't see that happening. It's not going to happen for all the things we've talked about now, plus the fact that people do have a lot of home equity, and home equity is that cushion that protects homeowners from being foreclosed.
Right. Home equity is point number three, right? I mean, this is the third point why we're not going to see a housing market crash. I mean, think about the last 30 days in our last 90 days in our local market, right? We've seen somewhere along the vicinity of 400 homes sell. Of those 3,400 homes, 2,400, that's 72% of all of the homes that have sold in the last 90 days have sold with either cash financing, all cash purchase, or conventional financing. A conventional financing scenario is a person who's got to put down at least 5% for the value of their home, but many conventional loans are in excess of 20%. So let's put that into raw numbers, right? Of the 3,400 sales last month, 700 of them were all cash, people who just put down cash and bought their house without a single mortgage. And the remaining 2,400 of them, it's actually 1,400 of them were purchased with conventional financing. That means people have a ton of equity in their homes. I mean, a whole lot. Even if they've taken out an equity line of credit to fund a remodel or a pool addition, they're still looking very, very well as far as the percentage of equity they have in their home compared to its value.
Yeah, that's right. Some recent statistics put out by the Department of Housing and Urban Development say that across the board, there's approximately $15 trillion of home equity in the United States. $15 trillion in a housing market that is worth approximately $26 trillion. That means on average, a homeowner has around 57% equity in their home. That's a pretty amazing number, right? Considering that most people only put 20% down at best. Some people only put 3% down when they acquire their home. But over time, with appreciation and with continued pay down of their debt, they've accumulated $15 trillion of equity in this country, right? That's an amazing number, astounding, right? And what's crazy is so much of that is being stored as a retirement account for so many Americans, right? That's our biggest asset is our home. And it's our biggest source of income at retirement is going to be, or inheritance to pass on to our children, is this equity piece in our home. I mean, it's staggering numbers, when you think about it as a whole of what we have in this country and what housing has done for people and can do for people in that regard.
It's an absolutely huge number. And to put real numbers on it, I mean, there's reports all over about what that number could actually be. But one that I read recently was that the average home buyer has $185,000 of equity in their home. The average homeowner. That's a huge amount of money, $185,000. And so when you have a median home sale price of somewhere in the 400s right now, you've got the average homeowner with almost half of that home value as equity in their homes. They're very, very well positioned. But what shakes everyone in their boots is that we get these reports about a correction in home prices. Let's say home prices fall from peak by 1, 2, 3, 4%. And then they look at these multiple trillions of dollars of home equity, and that's a splashy headline, isn't it? The housing market loses $50 billion in home equity this month as home prices fall 3% from peak, right? That's the kind of absolutely dishonest, completely alarmist reporting that we get all the time from our flagrantly unhelpful media as they try to ramp up fear in equity. But the equity picture is not a fear-based picture right now. Generally speaking, for most folks, the home equity picture is a wonderfully wealthy picture. Their household wealth is heavily connected to that, but it's a very large number for most people in America right now. Unless you're a person who's bought your home at the absolute peak of the housing market 4 or 5 months ago. You're a person maybe who that home equity picture doesn't look quite as good for right now. What do we say to people like that? I mean, we've been saying it since the start of this podcast. Be patient. Don't rush a selling decision just because of a splashy headline saying that you've lost some home equity. Hold on. Even if you bought at the peak of the housing market, a duration of time will pass where you will be very well positioned in your equity picture. It's just not going to be fast. It might be a few years. It might be as many as 10 years. Just hold on and don't make a hasty sale decision that would put you underwater in that equity picture.
Yeah, and I think one thing to reassure people is when you look at the fundamentals of owning a home, what's the first rule of real estate, right? It's location, 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 right? Think about where you own your home and think about how many people are moving to this area and think about how much vacant land there might be or really not be around you to build additional homes. There's probably not a lot of vacant land to build homes around you. People want your location. So that inherent demand for what you've got is going to continue to make your asset more valuable. Over time, your asset is going to increase in value. So patience is the key, right? Will we go through some peaks and some troughs? Of course we will in the market. But with all the things we've talked about that we have going for us here in Tampa Bay, with all the people moving to Florida for the wonderful economic environment that's presented here, with the bustling and expanding new airport we have that allows travel in and out of this area, the beaches, the bays, all these things, there's so much inherent value in Tampa Bay that has just started to be realized over the last 2 years, and starting with the COVID pandemic. And so don't panic. There's plenty of people in this market that want your home and will be willing to pay what you paid and even more, if not today, in the days and the years to come.
Well, one of the key elements of the last housing market crash was defaulted mortgages with insufficient equity. We had people who could no longer afford their home, their mortgage. They didn't see a way out because the value of that home was well below their equity picture. And so it pretty much was a liability to them. It was not an asset at all. And so those people defaulted at higher rates than people who had equity in their homes. That is not the place we're at today. And in order for us to see a major surge in foreclosures, we're going to have to see a massive erosion of home equity, almost to the tune of 50% in many cases, given that the median sold price is somewhere around 400 and the median equity is 185. People have got to lose almost $200,000 in home equity before they're in an underwater position, which is not even the most dire prognosticators are saying is likely here. We will see a price correction potentially from peak. It will not do anything to erode equity in a meaningfully substantial way for most people. And we're simply not going to see a crash in the housing market because the home equity picture is way too good for most.
Yeah, so much of this is really psychological. When you go back to it, 3 years ago, we were buying homes in the Temple Terrace area for $160, $165 a square. That was max appraisal 3 years ago. Now we're at $220 a square. We're up 35, 40%. And for people that have been around a long time, that seems like an outrageous increase, right? It seems like, wow, I paid $250,000 for my home. Why would someone want to pay $450 for it now, right? Those kinds of head games are interesting, right? But they exist and they affect the psychology and the psyche of people in the market. And they get people thinking that things shouldn't be the way that they actually are, right? And that's why in this episode, we're trying to address some of these statistically factual fundamentals of where the market actually is and why it's there, right? So many media outlets are trying to get everyone to think about the extremes. But really, in reality, everything comes back to market fundamentals and why things have happened the way they've happened. And with supply, with demand, strong economy, home equity, all of these things bundled together, present us with a pretty good picture right now, a pretty good picture now, and a pretty good picture going forward. This is not 2008. I have not been able to get a ninja loan in 15 years, right?
Thank goodness for everyone.
Right. Yeah. I mean, like, yeah, what was it? 23% in the last 90 days, 23% of home purchases in Tampa Bay were for cash, entirely cash, right? And another 72% put at least 5% down. That wasn't happening in 2008. We were putting nothing down and we had no job, right? We had a decent credit score, we had no job, and we had nothing to put down, and we still got a home. No one's been able to do that for a long, long time.
That's a scary reality that was going on. That's not where we are today, anywhere close to it. I just like to remind listeners, and I think this is my piece of advice to you, is you're listening to all of this, and then you're juxtaposing this against everything that you're hearing in your social media feeds and on the news. Real estate is a long game, right? Time will heal mistakes that you make in your real estate decisions, whether that's investing in real estate or in your primary residence. So I've been at this for 23, 24 years. Many people who are listening to this show have been at it for a lot longer than that. And every one of them will attest to you, just hang on. If you're concerned, if you're worried, take a step back, take a deep breath, turn off some of the naysaying news, and allow the markets to play out. Allow the scenarios of whatever it is we're in for right now as far as a recession goes to run its course. Allow demand economics to continue to buoy the market as they will. Watch as Florida continues to make good economic policies that attracts great demand into our state. And all of those factors will lead to a correction and a recovery in your pricing in the years ahead. Just be patient and don't panic. It's going to be okay. And I think the 3 reasons we've given are absolute ironclad reasons why you do not have to be worried in a crash in the Tampa Bay housing market anytime soon.
Yeah, and if you're sitting on home equity, just remember that if the economy does face a downturn and a recession does come by chance, being in a fixed asset and having equity in a fixed asset is where everyone will tell you to be. Okay, so sit on your home equity, use it opportunistically, but be careful. And you may not want to put it in the stock market, because you talk about a volatile market where you can lose everything overnight. That's your market.
That's exactly right, Chase. Where can people go to learn more about all this?
Hey, check us out at homeprop.com.
Well, it's been a blast always. Great talking with you about these really important things. And until next time, take it easy.
All right, have a good one.